So I've been doing this podcast for just over 3 years and I really want to bring it live for you all. So I'm going to need a favor from you. If you're interested in seeing the Savvy Wallet podcast live, please register your interest by signing up to my mailing list with the link in the description of this episode. Thank you so much for your support so far.
To get rich, you want to invest. Essentially, it's very hard to save your way to wealth. You need to invest into whether it's like property, stock market, crypto, your own business, whatever it is. You need to invest to build your wealth. After 1 year of investing, I had £1,000. After 2 years of investing, I had £5,000. After 3 years, I had £17,000. And that was all on like a few £100 here and there a month. Now, I'm doing like 4 figures per month. So that has massively helped me essentially build my pot. Like in the last 2 months, just from gains from the stock market and the crypto market, I've made nearly half the like average UK salary by just doing nothing.
That's crazy.
And like if I hadn't started 7 years ago with £100 a month, then it never would have got to that point. Compound interest is the most important topic when it comes to investing, but it's also misunderstood and often overcomplicated. Someone like Warren Buffett has felt the full effects. He's in his 90s, 99% of his wealth is from compound interest. I'm now slowly starting to see already the power of compound interest on a 6-figure portfolio and how it can grow and compound and snowball your wealth.
You said in your book, becoming a millionaire is simple. Break that down for us. How is becoming a millionaire simple?
You're not defined by where you come from.
Yeah.
And I think that's a big message that I always want to tell people. Like
you have to be able to be uncomfortable. Like be comfortable with being uncomfortable.
When you grow up in ends, you don't realize it when you're confident, but you have an audacity to do things that ordinarily most people wouldn't be willing to do.
Welcome back to another episode of the podcast. You can see that we're in a different studio, a very, very special, this is a very, very special episode with a legendary person, actually. He's been doing this longer than me and he doesn't even live in the country. So, Ryan, how's it been, man? It's been a long time.
It's been a while. It's been a couple of years. It's good to be here.
Yeah, I know.
Talk some more about investing.
Yeah.
New studio.
Honestly, we've had I think this is going to be like our 3rd episode that we've done together, but I think this is our first in person.
No, we done one in person.
No, you're right. Yes, you are.
We did one in person a couple of years ago.
You are right. We did. We did. So, but this is going to be the 3rd one, and this is. I'm going to say it now. It's going to be the best, man. It's going to be the best. A lot has happened since that episode. Obviously, the podcast's growing bigger. You've done a lot of things. You're now a published author.
Yeah, I know.
Which is crazy.
No, mental.
But obviously, let's give a bit of an introduction to you. I know you as Money Making Simple. You've been doing, sharing personal finance content for, almost coming up to 6 years. Great investing content. I would say you're kind of like, when it comes to like investing in global index funds, you're definitely the blueprint. Let me not even cap. You are the blueprint when it comes to that. Oh no, honestly, I have to
that's my whole approach, to be fair. So I then share it.
When you started talking about it, that's when I realized everybody else started talking about it.
I'll take that.
No, I'm being real. I gotta be honest, right? So I want to give props to you about that. So yeah, obviously I described you in a nutshell. You're also an accountant. Do you still work in the Big Four?
Yeah.
As well. So you still work in the Big Four?
Doing that in Australia now.
Yeah, now you're doing it in Australia.
No,
but you know what? Let me let you give a bit of an intro into who you are.
Yeah, so I'm Ryan King. I'm 27 years old. I do work day to day, still doing a 9 to 5 as a chartered accountant. But as a side hustle, I'm still doing Making Money Simple. So I started in 2019, nearly 6 years ago now, originally just as an Instagram page. And now you can see it's grown a bit. So I'm doing some podcasts with you and obviously got a published book, Stop Waiting, Start Investing, coming out November 26, 2024. So it's pretty mad. Feels like yesterday I started posting a few like infographics or some very basics on Instagram, and now it's like podcast, book. It's mental.
Yeah, it's crazy, man. You've done some amazing things, and this is going to be a very important episode, especially with investing. I feel like so much is happening in the world of just personal finance, the economy and stuff like that. There's a lot happening, but before we get into that, right, how's it in Australia? Like how are you finding it there?
Yeah, it's pretty good over there, to be fair. It's a good lifestyle. Because the work-life balance is a bit better. I can see why. I think I will come back, but I can see why people go and then never come back. There's obviously a big expat community of English and Irish over there. But no, it's good. I guess the one thing I didn't appreciate though, it is so far from every other country. Whereas when you're in a lot of Aussies do come to London because then it's so easy to then travel around Europe, like 2 hours, fly anywhere, 3 hours. In Australia, you fly 3 hours and I'm only getting from Melbourne to Perth. Like, I'm not even out of the country. So, but no, it is good lifestyle, good thing to do for a few years. I think I'll come back to London at some point now.
You think so, yeah?
Yeah.
Okay, but why did you end up leaving, actually, UK? I don't know
I
if we
sort
ever
of-
spoke about that.
Yeah, I sort of qualified as a chartered accountant, had been working and living and renting in London for a few years. And then I just sort of fancied the mix up. And I got this opportunity to a secondment to go to Australia. And I was like, didn't know anyone in the country. It could be a bit mad. But I was like, yeah, let's do it.
Okay.
And then the rest is history now.
Mad,
I've been there for 2 years now.
Mad.
And yeah, it's absolutely flown by. Like, it feels like 5 minutes ago I went there. Now it's 2 years. And I'll probably do another 1 or 2 years there and come back. So that's what I say
you say,
anyway.
and then you end up like doing
Yeah,
20 years and
yeah,
then come back like
I know.
20 years later.
Never come
man.
back.
That's crazy. What would you say is like of some other lessons that you've kind of learned in your time there, especially like from like a personal finance kind of point of view? What kind of have you kind of learned about not just, you know, personal finance, but like the system, the money system out there too?
So I definitely learned being an investor is much better in the UK. So it was actually interesting because I went on over there. It's like you learn like their pension system, which is called a superannuation. You learn like, I guess how to invest, what platforms are available. But I do invest my Aussie Dingo dollars every month, of course. But I think it's actually much better being an investor in the UK. Number one, there's no stocks and shares ISA equivalent in Australia.
Really?
So you got to use a general investment account, which has no tax advantages. Number two, there's actually no employer match. So I used to get a 6% employer match in London, and I know a lot of other people get much better matches than that. In Australia, there's no actual employer match. You have to put in by law 11% of your own salary, but that's just your own money. So it's not actually matched by the employer. And there's also, I use Vanguard Australia, Vanguard UK, but it's generally quite a lot less choice, I'd say, with investing platforms. So whilst I do still invest, and I've been like using my Aussie salary to grow my obviously wealth, and I guess one day I'll bring it back here. I'd say it's actually a bit easy to get started in the UK just because with like pensions, stocks and shares, ISAs. But it was good like learning about the system because it's almost like back to day one, like what platforms are available, what accounts are available. Then I'm trying to find like a global index fund, which we'll talk about, like what's the best one to invest into, because all the fund options are different. Because obviously in the UK, I was investing into like UK sort of like domiciled funds or local funds, but then Australia have their own sort of set of different index funds and ETFs. So it was a bit of a learning curve, but it was actually, from that point of view, it was actually quite interesting learning about all the new stuff. But I feel like Aussie culture is pretty similar to England, like how it is. I'd say it's like a mix between like America and England. There's definitely influences of both, or America and the UK, I should say. But when it comes to sort of like the culture and like the banter, it's very similar to like the UK. So I'd say like the money sort of like outlook is a bit similar to the UK as well.
Interesting.
How they look at money and stuff,
Okay. That's interesting.
It's still very much like, I guess, like most countries where, most developed countries where it's like, get a good job, work your way up, get a house, get married, have a kid, you know, like the standard path.
Very similar kind of thing. Pay all taxes,
Yeah.
obviously, and all that.
It's similar to the UK in that sense,
It's so interesting that they don't give them any tax-free advantages on like, you know, like investments.
So the pension system, the superannuation, how it works is you pay 15% tax when the money goes in, so you pay a lower rate of tax, and then it does then grow tax-free. But then when you then withdraw it, a bit like with UK pensions, you have to pay tax again. So there is still like some tax breaks, but I'd say the tax advantages are not as good probably as using like workplace pensions and stocks and shares ISAs in the UK.
Okay, so maybe we're downplaying the stocks and shares.
Honestly, the stocks and shares ISA is literally the best investing account.
Yeah.
Because even in America, the Roth IRA is only a $6,000 allowance.
Wow.
Here, the £20,000 stocks and shares ISA allowance is like genuinely the most OP, like overpowered, the best account, I think.
Yeah.
Like any money you put in grows tax free, massive £20,000 allowance. You can access it whenever. It's completely flexible. There's so many providers, such low fees, thousands of options to invest into. I of course just use global index funds, but if you're in the UK, just you have to use the stocks and shares ISA, and that's like a whole section in the book. It's like that's so powerful, and if you can combine that, and I'm probably jumping ahead here, with a workplace pension where you're getting an employer match. That's what I had done for years, and that's like what built sort of the foundation of like my portfolio from £0 to 6 figures over the last 7 and a bit years now.
Amazing.
Yeah.
You know what? Let's just jump right into it, you know, because I know people
Sort of jumped ahead there already.
No, it's all right. It's all right. We're getting right into it. I know people want to hear like how you built your portfolio, right? Which is in the hundreds of thousands, right, of pounds, right? Which is impressive. And you did that, as my understanding from reading your book, 7 years, right?
I started originally in August 2018.
Yeah.
Or no, accidentally, sorry, in August 2017, because I did a industrial placement year in between my second and third year of uni, and then in August 2017 I got auto enrolled into a workplace pension,
Right.
and I didn't realize I was an investor, because obviously if you have a pension, you're an investor and it's your money. That's a whole separate point. But yeah, so August 2017, I say I accidentally got started investing, which is 7 years ago. But then I properly started in about August 2018 when I started actively contributing part of my sort of money every month to it.
Amazing.
So 6-7 years, yeah.
Amazing. So we're going to talk about that. And 7, you know what's crazy? And I think this is why I really want to kind of go through this, because a lot of people are going to think, okay, Ryan's got £100,000, right? He kind of started with like loads of money, right? And that's not the case. And this is why I think, you know, talking about this is so important. And you know what, let me ask you the question, right? So let's first talk about what you're invested in, right? And roughly, you don't have to give like very like specific, like to the point percent details, but you know, how much is allocated to kind of each of your investments?
Yeah, honestly, it's actually very simple. It's like I have about 85% in index funds.
Okay.
And then 15% in crypto.
Oh, is that it?
That's pretty much it. Yeah, I think I've got like a couple of I've got like a couple of shares in like Diageo, who are the company who like sell Guinness, because I'm a big fan of Guinness. Okay. But like I've literally got a couple £100 in individual stocks, and then I actually checked my portfolio earlier on. So because of the recent massive boom with like Trump being elected and everything, it's now up to £140,000. And yeah, about 80 to 85% is essentially in global index funds.
Okay.
There's then 15% in crypto, mainly Bitcoin and Ethereum, half and half, and there's maybe like 0.5% in like individual stocks and like other random stuff. But yeah, it's essentially global index funds and a bit of crypto.
That's crazy.
And it just keeps my approach very simple. Yeah. I'm not. I could have like a load of stocks, a load of different funds, but essentially in every single investing account that I've got, I just hold one global index fund or ETF. So like my Vanguard Stocks and Shares ISA and Vanguard SIP in the UK, all the money's in a global index fund called the FTSE Global All Cap.
Yeah.
My Australia Vanguard account, all the money in there is in one fund, a global ETF called VGS. My then UK and Australia workplace pensions, all of the money in those are in like global index funds. So it's not necessarily the same global index fund, because different platforms in different countries offer different ones. But I generally just like look through the fund list, search global or world, try and find the most diversified, lowest fee fund, and I just invest into that.
Okay.
I know people like to invest into the US markets and the S&P 500. Everyone sort of bangs that drum, and you can do that, but by investing into the global index fund, 60% of my money is still going into the US markets, because that's what it makes up with the global stock market. So if the US market continues to do well, the global index fund also continues to do as well. But it's also a bit of an insurance policy. And I go through a lot of the data in the book. If you look over 100 years, the stock market ebbs and flows, and the best countries regularly changing. And I'm probably jumping ahead a bit here again, but that's why I like global index funds, because there's no guessing. I'm owning every country, every company, and whoever does the best, I'm just going to take part of that. Of course, don't get me wrong, if I'd put all my money in like one specific company and that done amazingly, I'm not going to get those unreal gains, thousands of percent, but very few people do. And that's a lot of luck anyway. So by owning a global index fund, all the luck's out of it, and I can just slowly build my wealth over time. And then hopefully what I've done now from like £0 to £140,000 over 7 and a bit years is like a realistic, you see a lot of like bullshit stuff on social media, like flexing Lambos and like making millions overnight. It's very much not like that. It's very much like a slow and steady, increase your contributions over time, do it every single month, and then 7 years later, boom, you got 5-6 figures. And
that's crazy.
That's like a very whistle stop tour, essentially my whole investment.
I love that. And what I really appreciate about you, and anybody can check your journey, you know, look, the receipts. Ryan got the receipts.
Look,
I'm the receipts. I've been following this guy for 5 years. I'm the receipt. I've seen the receipts. This guy, I think what I appreciate, you're transparent from the jump in terms of, you know, what you invest in every month how much you invest in, where your portfolio is. A lot of people don't do that.
Yeah.
Right. So your journey can actually be tracked to show actually it is possible. So yeah, again, we're gonna go through a lot of this. So I just want to get understanding for people, because investing, people, there's still this mystique for some reason. I do want to continue talking about the podcast as much, investing as much as I can on the podcast, because I know how important it is, but some people are still catching up to it. So in terms of making money from investing, how does one actually do that?
Yeah, so when it comes to the stock market, it's really most sort of, I guess, any asset you invest into, but looking at the stock market as an example, it's really capital gains and dividends. So capital gains is just when the value, if you invest into like a stock or a fund and it was £100 yesterday and it's £200 today, you've made £100. That's capital gains. And also normally when you invest into funds specifically, they'll inherently own hundreds or thousands of companies. Like the FTSE Global All Cap owns 7,000 different companies, and it will then normally pay a dividend. So sort of capital gains over time and dividends. And then a sort of bit of a hack is if you can reinvest all those dividends by using accumulation index funds and ETFs, then you can sort of automatically grow and snowball your wealth quickly over time.
Amazing. Thank you so much, because I think that clears up for people on how you can actually make money from investing. I think people don't really sometimes get that, so thank you for
I think why it's difficult is because like, and even in the early years it does seem pointless, and I thought this myself. Like, we can go through, like, I actually got written down on my notes how my investment portfolio has grown over time, but after like 1 year of investing I had £1,000, after 2 years I had £5,000, and it's like, okay, I've got £5,000 invested, even if the market does like really well, I've made like 300 quid, like what's the point? But then when now, like the last month or so, or actually the last 2 months, I tweeted about this the other day, because the markets have been performing so well, the stock market and the crypto market, of like inflation coming down and then Trump getting elected boosted the market massively. I've made £15,000 in the last 2 months. And that's really because I built up that base slowly over time. And now I guess when you get to sort of 5-6 figures, you sort of, when there are good days or good months, you really feel it a lot more. But I do understand at the start, it can feel pointless. You get like a 2% dividend per year on £1,000, or you make like 15% on £2,000. It's like, what is the point? But you really got to try and envision the long term and just think about if you can keep being consistent every single month, you're going to get to 5 figures, you're going to get to 6 figures. And people do say the first 100K is the hardest. But then once, and I've felt this myself now, once you get to 100K, when the market has like a couple of good months, it's like all of a sudden you've made like thousands, tens of thousands of pounds. And it's absolutely mental. Like in the last 2 months, just from gains from the stock market and the crypto market, I've made nearly half the like average UK salary by just doing nothing.
That's crazy.
And like if I hadn't started 7 years ago with £100 a month, then it never would have got to that point. So you sort of have got to, in classic like football terms, trust the process and like sort of see it through and not just like give up when the market crashes or panic. And I think that's why reading a few books, becoming a bit more financially educated is helpful, so you can understand it's a long-term thing, the market's volatile, there's going to be booms and busts, but ultimately overall, as companies become more productive and innovative, the stock market will go up over time. And by investing into that through a pension, a stocks and shares ISA, you can build your wealth tax efficiently as well over the long term. And that's sort of what I go through, and that's really, as you said, what I've been sharing that like exact stuff for like 5 or 6 years now. I still get people that message me like, oh, I had one over there, was like, oh, I saw your like followed you in 2021 and I was going to start investing and I still haven't, can you help me?
Oh,
I'm like,
no
oh
way.
my god,
No
just
way.
if you're listening to this and you haven't started, even if it's like a tenner or 100 quid, just start because it's something you literally cannot put off. So you put it off, your money's losing out to inflation in the bank. If you spend it, it's obviously gone. So you have to invest it to grow your wealth. And if you're not investing it, then you are just falling behind. And I guess one way to look at investing is the more you can invest and the earlier you can start investing, you're essentially going to retire yourself earlier. Because even if you start investing a small amount, imagine you've got a nice 6-figure pot for investing a small amount every month for 30 years. You might be able to retire 5 years earlier, take on a more enjoyable part-time job and step down from your stressful corporate job. So there's so many long-term benefits, but you sort of have got to see the long-term vision and like trust the process. It is a bit sort of pointless in the first few years, but just stick with it. And if you haven't obviously started, stop waiting and start investing.
I love that. I absolutely love
Had to
that.
get it in there.
You know what I want to know, right? And I think what everybody wants to know, and what I kind of want to highlight to people is, how much did you actually initially start with?
Yeah.
When you started investing, what was like your first investment?
So my first actual investment, I would just set up like £100 per month when I first started properly investing. So I obviously got auto enrolled into my workplace pension in 2017. But when I sort of first understood what I was doing and properly started investing, it was £100 a month into a Vanguard stocks and shares ISA. I made a lot of mistakes before that, and I go through them in the book. Like, I initially opened up a account with a high street bank. I dabbled with some individual stocks. I was paying high fees, like FX fees. I wasn't using the ISA or a pension. I was using a general investment account. I made a load of mistakes. But when I sort of properly started, it was, about August 2018, Vanguard stocks and shares ISA, £100 a month into the FTSE Global All Cap. And then, sort of built it up from there over time.
Okay.
And I think, like, I've really not done anything complicated. So I haven't, like, inherited anything. I've not done anything special. I'm not like a genius. I literally just use my workplace pension. I got a 6% match for a number of years. And then my stocks and shares ISA, put what I can afford every single month into that. And as my salary grew, and it's really my own salary that's built most of this. So as I became a chartered accountant, I got a big salary jump, and I then increase my investments per month even more. But most of the bulk of my investments has really just come from increasing my 9-to-5 income. Like, there's no sort of special hack. It's just stuff everyone knows. If you can increase your income for your 9-to-5 or for a side hustle, like I've done as well, then you have more money that you can then put into investments per month. And there's not much you can control when it comes to investing. But one of the most important thing is your own contributions. And of course, it's very obvious to say, but if you can contribute more per month, you're going to build your investment pot quicker. Yeah. And then get to 6 figures quicker, and then hopefully get to financial freedom quicker. But most of it's just been like basics. And you can almost write it on like a little sheet, like a revision card. Use your workplace pension, take advantage of the maximum employer match, open up a stocks and shares ISA, put in what you can afford, and then increase both of those as your salary goes up. And then you're going to build wealth. I
love that. I feel like investing is a bit like, you can kind of liken it to like a marathon, right? It's just a really long marathon to the finish line, right? And
it's definitely a long-term thing.
It's very long-term, right? Like, I feel like it's like anything. I've never ran a marathon. Have you ran a marathon?
I've done 2 this year.
You've done?
Yeah.
Okay.
Not anymore for a while now, though.
Oh man, I'm not gonna. Oh, boy, I guess you get tired of the marathon. Oh, that's crazy. But I see it like a marathon, or like, like climbing the mountain. It takes long. It takes a while, right? But you can eventually get there, right? It's one of those kind of things. So that's what I kind of like liken it to. So I feel like you wouldn't have not gotten to where you got to without those, like you say, those small steps that you initially did, and
the mistakes as well. Like, I hope by sharing the mistakes, other people won't make them. But you're almost certainly gonna make mistakes when it comes to investing. Like your first gym session, first interview, you're gonna make mistakes. And you sort of learn, and it's better to make those mistakes early when you're younger, with like a few £100 than like with hundreds of thousands of pounds. But the biggest mistake you can of course make, and this is a bit of a cliche, but the biggest risk is not investing, because as you mentioned, if you're not investing, your money's just going to be losing value due to inflation, just doing nothing. Like, if you had £1,000 sitting in the bank 10 years ago, and you've still got that sat in the bank now, you would have earned some interest on it, but almost certainly it wouldn't have beat inflation, so it's worth less. Whereas had you invested £1,000 into the US stock market or the global stock market 10 years ago, you probably would have made thousands of pounds. And that's just like the nature of investing over the longer term.
Exactly. Like, and I know that people are probably looking at the S&P 500 or FTSE Global all kind of be like, oh, why did I not invest in that? And it's like you say, right? If you don't get on the moving train, the train's going to just leave you, right? You gotta try and catch on at some point, right? So okay, so you started off with £100, right? Now, how much are you roughly like investing every month?
I actually uploaded a reel on this literally 10 minutes before we started.
Okay. Oh, really?
So go and like it first of all.
Yeah,
no,
I will. Don't worry.
So last month I invested essentially, I think it was £1,562.
Wow.
So it was all in Australian dollars, and I just converted it into pounds because I'm investing using my Australian accounts now. But now because I'm a chartered accountant, and I've been working a 9-to-5 now for like 6 or 7 years. It's pretty mad. The time's just flown. I'm now on a higher salary and I can invest more per month essentially. Like when I first started out, it was 100 quid, then a few hundred quid. But now, one of the reasons why I have been really able to build my portfolio quickly, especially the last 3 years, because most of that £140,000 now it's up to has come for the last 3 years. And it's when I qualified as an accountant in October 2021, I just prioritized investing, to be honest with you. I still had fun, went on holidays, nights out, all of that stuff, but I always sort of paid myself first through investing, or I say tax yourself first. Max out your workplace pension, put aside some money into your stocks and shares ISA, and then as your salary increases, continue to invest more and more. And that's what I've sort of done over the last few years, whilst increasing my income through making money simple as my sort of side hustle. Any bonus I get at work, I invest it. I've sort of just done my best to increase my income in whatever way I can and then invest. So it's nothing really too special. And all the money goes into global funds. I'm not staring at charts all day, doing any of that bullshit. It's just literally get money, global index fund, get money, global index fund, a little bit of crypto, get money, global index fund.
Okay, amazing. And I want to talk about this, right? Because I think this is important, of the habit of starting small, but often and, frequent and over the long term. What impact have you seen to your investment portfolio, for your stocks and shares, right? What impact have you seen by, increasing like your contribution from like the 100 to like the 1,500?
Massive. So first of all, starting small and building that habit is probably one of the best habits you'll ever build, by actually putting aside a portion of your income every single month and invest in it. The best advice is really like invest whatever you can afford to, but I know people like specific goals to aim for. So I'd say either £100 a month or 10% of your income. If you can just focus on that first of all, start doing £100 a month, start doing 10% a month, whichever you want. And then over time, what you'll probably find is you'll get a bit more addicted to trying to invest more and more, increase your income to invest more and more. But yeah, building that habit is definitely key. But yeah, I'm not going to like bullshit you. If you can, now I'm investing £1,500 a month. My investment portfolio grows much quicker. If you think about it, actually, after 1 year of investing, I had £1,000. After 2 years of investing, I had £5,000. I think after 3 years, I had £17,000. And that was all on like a few hundred quid here and there a month. Now I'm doing like 4 figures per month. So that has massively helped me essentially build my pot. And that's really just like, I guess, just through my 9 to 5 work. It's not sort of any like fake guru, flashy social media stuff. It's just like get a 9 to 5, work your way up. It's sort of boring, but it's actually really how it's like the Millionaire Next Door, that really good book. How most people who are millionaires are just sort of self-made millionaires by just over an extended period of time, often decades, have been frugal, still had fun, but then invested. And then that sort of combination, you're like always going to build wealth if you can be a bit more frugal and invest every single month.
Yeah, amazing. So what's like the ultimate goal you're trying to achieve by investing?
Yeah.
Do you want to
Obviously
share?
get the Lambo. No, I don't think I'll ever get one. If I had millions, maybe. No, the ultimate goal would probably be to essentially retire early.
Okay.
And then, because I think obviously corporate job's fine, like it's good. Like I know you've got one as well, but then it is a bit obviously restrictive. I don't know if that's the right word, but you sort of got like a boss and you got to be in certain places on certain days, where imagine if you like didn't have to do anything on any day because your investments are paying for your lifestyle. And even if you start later or have a smaller pot, imagine if you could part retire, where you leave your stressful job and get a more enjoyable part-time job, and then your investments top up your income. So I think if I can retire early, 5, 10, even 20, like how many years it is early, because I can live off of my investments, then you can like spend more time with family, future kids, grandkids, actually do stuff you like genuinely enjoy, hobbies, rather than just like working for 50 hours a week every week until you're 65.
Amazing. Do you want to tell us how much you want to get to?
I actually don't know.
You don't know?
People,
Okay.
People actually
Probably have asked you,
people do ask me, and like I feel like I'm still very much like I'm still like working a 9 to 5, obviously making money simple on the side, and I'm still very much in the wealth accumulation phase.
Right.
Where I'm trying to just earn as much as I can, invest as much as I can, and just sort of do that at least for the next few years, for the rest of my 20s, and then maybe when I get to my like early 30s, I'll reevaluate. if I've got like a mortgage and kids, I've still got like very few responsibilities.
Yeah.
So I can sort of use my money to either invest or like I'm living in Melbourne, having fun in Australia. But I've not really got an end goal. Yeah, maybe as I get a bit older, I'll come towards an end goal.
Okay.
I know they generally say obviously the whole 4% rule, where if you can say your investment portfolio is £1 million, you can withdraw 4% per year, £40,000, and then live off of that. So I probably need to try and work out what my future yearly expenses might be. Then I can work out how much I'd need to get invested to then actually, I guess like technically reach financial independence.
Yeah.
But I've not actually really thought about that yet.
Okay.
Probably should be in a finance content creator, but not yet.
Not really. I mean,
I'll put it off for a few
it's look, you're being honest at the end of the day, right? About it. You're in the wealth accumulation phase, so you're not really focused too much on what that number is. And maybe the thing is, I think I struggle with that number too, because I feel like that number changes. With obviously not just inflation, but I just feel like with the lifestyle that I want,
It depends what
it's
lifestyle
like,
you want. Because I feel like if you are, I think what will surprise people is if you are quite frugal and minimalistic and not materialistic, like you don't need a big house, flat fancy cars and watches, and I'm not really like that myself. If you don't need that stuff or don't want that stuff, then you can actually retire on a lot smaller investment pot.
Yeah.
I think the reason why people get trapped for years and years and never retire is they end up buying like a house that's too big, a car that's too expensive, all this like crap, trying to like keep up with like the Joneses or Kardashians, whatever it is. Like lifestyle inflation essentially is what I'm talking about, where as your salary goes up, your expenses go up, and then you can just like never retire because you're bound to all this debt and all this like crap you have. Whereas it was a bit more frugal and materialistic and minimalistic. Not that I'm trying to preach to anyone, but then you can probably retire earlier and retire on a smaller pot, and then actually start doing stuff that you like doing and it makes you happy, rather than just working forever and ever and then dying.
yeah. That's the thing. Like it's you're absolutely right about those expenses, because if you've got like, I don't know, so imagine you've got like I don't know, my maths might be wrong on this, people, so don't come at me, but let's say you got like a £70,000 car, right? I don't know how much that is a year, but let's say, actually let me reframe it, let me not say £70,000 car. Imagine let's say you're paying for a car, you're paying 1.5 for a car, then your mortgage is $2,000, and then I don't know, you've got other expenses. Let's say you're all in, this is a ridiculous example, I'm just putting it out there, let's say all in your expenses are $6,000 a month, right? Essentially, for you to be able to retire, your investment pot has got to be able to yield $6,000 a month for you to be able to be like, oh, I'm comfortable living like that. So that's what you got to kind of think about. And I think a lot of people don't think of it from that perspective. Sometimes I feel like we're so busy in the rat race, we're getting promoted, we're working hard, we're doing well in our businesses, and like you say, as we go up the ladder and we earn more money, naturally we just become bigger spenders, to the point where, like you say, we trap ourselves. So it's a bit of a balance, right? You don't want to be like, if you're not necessarily a frugal person, you don't need to put yourself in that. Right? I was speaking to somebody, and let's see, when they come back on the podcast, they can say it to them. They were like to me, look, they're not frugal, they're not about that lifestyle.
That's fair enough. A lot of people aren't,
right? But they had an answer to it. They were like, I'll just make more money. I'm just going to make more money with my side business. I'm just going to make more money.
If you can do that, then fair enough.
And that is the answer, right? If you don't want to be frugal, just work harder, right?
Yeah.
Like, I'm not trying to say in a patronizing way of like, you must work harder. I mean, just understand that probably have to make more income, right? To sustain that lifestyle, right? So I think is a very important point for people to understand. Where are they? Like, what are they like? And adjust to what you're like. If you're like one of those people that you like lifestyle, you like spending, just also know, okay, you probably have to have a high income, right? But also don't use up all of your income.
Well, that's the problem. Like a lot of people who are on like 6-figure massive salaries still live paycheck to paycheck. Yeah. Because then it's almost like even more pressure to have fancy stuff and go to fancy restaurants. And that's why almost like having just like a standard 9 to 5, you can just build your wealth silently in the background and then one day just disappear. But a good quote that I like is, I don't know exactly how it goes, but it's like essentially spend, I think it's from Ramit, the guy that wrote I Will Teach You to Be Rich, which is another good book. Something along the lines of spend extravagantly on the things that you love and that bring you happiness, and then cut the costs mercilessly on stuff that doesn't bring you anything.
Yeah.
So I think a lot of people spend money on, and this is obviously going off topic a little bit from investing, but on just like designer clothes and like expensive watches. Like you don't really need it. Like you could invest that, fair enough. But you could also just like spend on something that's actually gonna like make you happy, like going on a holiday or like doing an experience or like going traveling or giving some money to your family, something like that. I think that people just spend that other classic quote about spending money on crap you don't need to like impress people you don't even like, and it's that whole like rat race, keeping up with the Kardashians lifestyle. I think if you don't get sucked into that, focus on increasing your income and investing, then you're gonna build wealth and be able to retire much earlier than had you not done those things. Yeah. But as you sort of mentioned, it all really does come down to your income. And to go back to the original question you asked me like 5 minutes ago, the reason why my sort of investment portfolio over the last particularly 3 years has grown so much is because when I qualified as a chartered accountant, I got a massive salary jump. I was able to invest then 4 figures per month, and then doing that month after month, and I never missed a month of investing for so many years, is what's allowed me to get to this point essentially. So amazing. It's obvious, everyone knows this, but like the obvious stuff, like you go to the gym, you do bench squat, deadlift, it works. Has worked for hundreds of years. Same as investing. Every single month, invest what you can and let your wealth grow.
That's crazy. Okay, so let's talk about this, right? You said in your book that investing is simple but not easy, and becoming a millionaire is simple. Can you break that down for us? How is investing simple and not easy, and becoming a millionaire simple?
So the reason why I think it's simple is because, and obviously with the subtitle of the book as well, Build Wealth with 10 Minutes of Work, you can literally get started, set up in minutes. You can go onto Vanguard's website, go onto the App Store, download Trading 212, boom, you got a platform. As part of the sign-up process, you open up a stocks and shares ISA, and you pick a fund, a stock, an ETF. Within 10 minutes, you can simply get set up in an automatic investment. But the reason, so it's simple, but the reason why it's not easy is because obviously it's the waiting game. You're not going to become a millionaire overnight. It really is compound interest, which we'll come on to, over the long term, that is going to build your wealth. And I'm now starting to see the effects of that really myself over 7 years. But now I'm thinking the next 7 years, next 20 years, it's almost like got me excited to keep investing. And if the markets keep being kind, then keep building my wealth over the next 7 years. But the reason why, so that's why I say it's sort of simple but not easy, because it isn't easy. Like you have to wait, you have to be patient, you got to be consistent. And that's just the reality of it. Unless you inherit a load of money or you have some like business you create and then sell for millions, you're probably going to be working for yourself or working for a company. And it's just, you got to be consistent and trust the process and do it consistently over the long term. And the reason why I say it's sort of simple maths is because you can right now just go onto Google compound interest calculator, and you can literally type in how much you're going to invest per month for how many years. And I normally use a sort of rate of return of 7%, because that's the average long-term growth of the stock market per year after inflation. Plug those numbers in, and you can almost see, it's not exact obviously, and the stock market doesn't go up in a linear fashion, but over the long term it averages that amount. So you can almost try and work out, based on how much you're investing per month and how long you're going to be investing for, how much you're then going to end up with. And it's very much just like a numbers game. Like if you can obviously invest £100 every single month for the next 10 years, you'll end up with a rough amount. But imagine you could invest £1,000 per month every single month for the next 10 years at the same interest rate for the same time frame. Because you can invest so much more, you're obviously going to end up with so much more because you've been investing so much more. So it's sort of, the reason why I think it's simple maths, because it really is just, the main inputs really are the rate of return, and I normally use 7%, time, and then your own actual contributions, which is the most important thing in your control. And by sort of tweaking those, you can then sort of see roughly how much you're going to end up with over the long term. But once again, I've mentioned this already, it can feel pointless in the early years, and it really is a patient game. But just get started, and hopefully you'll sort of see how it builds up quickly. You'll feel motivated, start getting addicted to investing. Then before you know it, you'd have 4 figures, then 5 figures. And then, then you'll probably look back in 20 years time. And then I even do this now. I'm like, I wish I invested more when I was younger. Wish I started earlier. Wish I'd done this. So no one's ever regretted not investing.
Yeah.
No one's ever regretted investing or starting too early. It's one of the best things you can do.
You always do look at the charts and be like, oh, I wish I was able to invest in the 90s, man. I might have been a millionaire and stuff like that.
I was too busy playing with Pokemon. I should have been buying houses in London or something.
So I guess obviously, the name of your book is, stop waiting, start investing. So, using that same name, why should people stop waiting and start investing? What's the impact of, starting early and often?
Yeah. So the reason why you need to stop waiting is because, a bit like we touched on, if you keep putting it off, you're not going to build your wealth. And your money is essentially going to lose to inflation. But the reason why it's so important and why you should start early if you can is because of compound interest. So before I got onto that, I will say if you're obviously a little bit older and you're listening, definitely still start. I get messages from people quite regularly being like, oh, I'm in my 40s or 50s. Is there any point investing? 100%. People are living longer than ever. If you're in your 40s, you might live for another 60 odd years, at least 30, 40, 50 years. Over those decades, you can still build a vast sum of wealth through investing. And even if you're starting later and starting with a small amount, you can still hopefully, as we mentioned, retire earlier, make your retirement more easier, pass money onto kids or future generations, give money back to charities, whatever you want to do with it, it's your money. But the reason why it is key if you start early is because of compound interest. And actually in the book, chapter 4 is on compound interest. It's 31 pages and the longest chapter in the book by quite a bit. And I think it's because compound interest is the most important topic when it comes to investing, but it's also misunderstood and often overcomplicated. It's simply where your previous interest, or in the stock market, your previous gains, then earn future gains. So by leaving your sort of return invested that you make each year, that return or gain then goes on to make sort of future returns and gains. And that's then when that snowball impact comes up. The opposite would be if you make £4, you withdraw it, make £20, withdraw it, you're then still stuck with that initial investment. And that's known as simple interest. You're not giving it a chance to compound. But by leaving those gains invested over the long term, that is then really where sort of the magic of investing comes. And if you once again use a compound interest calculator, you'll see that over the longer you increase the time period, 10 years, 20 years, 30 years, 50 years, more and more of your return will be made up because of compound interest and because of leaving those previous gains invested. So the reason why it's so important getting started early, and there's a number of examples that I've talked about on my social media and in the book, is that if you start with £100 at 21, you have so many more years of compounding ahead of you than say someone who's 31 or 41. So you have more time that your money is actually invested in the market. So the more time you're invested for, not only can you ride out any ups and downs, because there are going to be booms and busts. The market's always booming, crashing. It's what it does. But you can also then accumulate more compound interest over the decades because your money's been invested for longer. So I think people think that, I'll start investing when I'm later on in life or when I've got more money. Do not do that. Even if you can literally only afford a tenner per month because you're 18 and you've got no money, or you're just started a grad scheme, you can only afford 50 quid a month. It's definitely better doing that if that's what you can afford to, because not only is it going to build a great habit and get you used to investing, get your sort of toes wet, feet wet, but you're also going to benefit so much more from compound interest, because that money that you invest once when you're 18 is then going to be compounding for 50 years to come.
Yeah, amazing.
And that is the beauty of investing, really. It's sort of like eighth wonder of the world, all of that sort of stuff. That's why compound interest is so powerful. Once again, it seems a bit pointless and a bit of a fairy tale in short term, but now I can say, looking back after investing for 7 years, it really is. I'm still not even felt its full effects, to be honest with you. Someone like Warren Buffett has felt the full effects. He's in his 90s, has been investing for 80 odd plus years, and 99% of his wealth is from compound interest. I'm only 7 years in, so I'm still haven't felt the full benefits of compound interest. But over the last couple of years, because the markets have been kind and giving good returns, I'm now slowly starting to see already the power of compound interest on a 6-figure portfolio and how it can grow and compound and snowball your wealth. So it will come. Just as I've said already, just be consistent, keep sticking with it, trust the process. And compound interest will give you most of your return over the long term, simply by just investing regularly every single month and leaving all of your gains invested. Don't touch the money. set up a separate emergency fund, use separate disposable income for traveling and for fun stuff, but leave your investments as grow and compound over the years if you're able to.
Yeah. So I get a lot of questions from people around, how to start investing, what should I invest in, stuff like that. And obviously I can never, really tell people that we're not going to give like financial advice to people, but I kind of want to help guide people in understanding what to look for in, ETFs and index funds, right? So when they are, let's say they find one online, right? Because there's a lot of like Morningstar and all these places that like have lists, right, on like ETFs and index funds. And I remember when I first started, I think I might have picked an ETF from Morningstar that was recommended. I just chose that one. But what factors should people look at when they are looking at a particular ETF to just get them to think, okay, yeah, this ETF or index fund which is, again, let me just explain. An ETF is a type of investment. You know what? I'm going to let you break it down. You break down what ETF and index fund is. And then, what factors should people look at to make sure it's like the right one for them?
Yeah, so all it is just like essentially a collection or a basket of different stocks normally. It can also be stocks and bonds, but if we're growing our wealth, we're really going to invest mainly into the stock market. I personally am, completely in stocks when it comes to my stock market investments. But you think about it, back to basics, your individual companies, Nike, Apple, Tesco, Asda, HSBC, they're companies, they got employees, they got offices, they're making products, trying to make money. You can then sort of group these companies together into indexes. So the FTSE 100 is the largest 100 UK companies. The S&P 500 is the largest 500 US companies. And then the FTSE Global All Cap is the global economy. The FTSE All World is another index. That's the global economy. So there's a lot of different indexes, but all they're really doing is grouping companies together. And then through index funds and ETFs, they're the vehicles we can actually use to then invest into the FTSE 100 using the FTSE 100 index fund, or invest into the FTSE Global All Cap by using a FTSE Global All Cap index fund. But the easy way to think about it, it's a basket or a collection of stocks essentially. So rather than us buying 7,000 companies, one share in every single company around the world, we can just invest into the FTSE Global All Cap, and that's going to automatically give us diversification to those 7,000 companies all around the world. So what should you then look for? And that's a very good question. There's two things that I'd say are key to look for when selecting a fund, because I get it can be pretty overwhelming and daunting, particularly with workplace pension platforms. A lot of workplace pension platforms, I find, I've had a couple, just aren't the best. The aesthetics are pretty poor. There's not always that many options available. So you might not have Vanguard funds like the FTSE Global All Cap. So what should you look for? The two things I say, essentially the fees, and then what it actually invests into, or the holdings of the fund. So to give like a real life example, my very first workplace pension, I got auto-enrolled into a really high fee active fund that was like 0.8% or something. It was invested into like random stuff like property and cash, and had some bonds, had some stocks. I didn't want to be invested into it. So I obviously am a global index fund investor. So I manually went through the list, and it is a bit of a manual process. This is on my workplace pension platform years and years ago in the UK. I typed in global and world, and I essentially then narrowed it down to a global fund that charged the lowest fee. And we're going to come on to fees, I know, but the lower the fees, the better, because you've got more money compounding over the long term. So that's number one. And the second thing is then what the fund actually invests into. So for me, I was looking for words like global or world, because I want to invest into a global fund that's investing all around the world, and the more diversified the better. So I'd say they're the two key things to look into. Almost certainly, so when it comes to stocks and shares ISAs, people pick their own investments, and if you're using the platform Vanguard, Trading 212 as two good examples, you're going to have good options: US funds, global funds. It's a bit more of a minefield with workplace pensions, and there's a lot of just bad funds. I had someone reach out to me the other day, actually. He had like been investing into this fund. He's pretty young, and it was like 25% in cash.
Oh, wow.
And I was like, mate, and he's been investing into it 6 years. I was like, mate, last 6 years, inflation's been at modern highs, whilst the stock market's also at all-time highs. So by that fund being 25% in cash, you would have lost out on huge gains had you just switched that fund to a 100% stock fund, because you're in your 20s and you don't need 25% in cash because it's a workplace pension, so you can't access it until you're 55 anyway. So you might as well take on a bit more risk because you've got 30 years ahead of you. So definitely you want to check your workplace pension especially. But yeah, the two things are fees, the lower the better, and the holdings, make sure it actually is invested into what you want it to. If it's got a load of cash, in that example, a load of bonds, a load of property, if you just want to be 100% in stocks, just make sure the fund is also investing 100% into stocks.
Okay. I love that.
And it can be a bit of a manual process, digging through it all, like typing in world or global or US, America, if you want like an American index fund, S&P 500. But you'll thank yourself later because in 20 years' time, when you've reduced your fees massively and you're in a better fund that's actually investing properly, you'll build so much more wealth by sort of fixing those 2 points. And the earlier you can do them, the better.
Yeah. And it's the time that you spend, that time up front, it's unlikely you'll spend it again. I mean, and if you do, maybe it'll be in a few years' time. It's not like every week or every month. Yes, it might seem like initially, oh my God, it's long. Because I remember I was doing the same for my pension as well. And I couldn't find like, I think there were Vanguard ones, but it wasn't like the same. It was a little bit different. So it took a few weekends. It took a bit of thinking, oh, okay. There was a few different global ones and it was like, okay, this one's a low fee. Kind of, they both do globally. Okay, this one's a bit more diversified. So, okay, I'll just take the chance with diversification of this one. And also actually the past, which, obviously we know that past performance is never indicated for future, but the past performance is a little bit better. Okay, so I'll go with that. To be fair, the difference between the two is not going to be probably massive, right? So it can be a bit of a minefield and it can be a bit overwhelming. So, doing your own research is important, but it's just taking the time.
You are right,
educating
though.
yourself as
the
well.
Upfront investment, it can be a bit like, oh, here we go again. Like particularly not because a lot of people, like most people, aren't interested in this.
They're not.
Listen, I like looking through the funds that are available. I'm like, this one is awful. Why are they even offering this one?
Yeah.
This one should be removed from the platform.
Yeah.
But most people don't like it, so I understand it's a bit like of an admin task, and it can feel a bit daunting and overwhelming. But by like reading the book, reading a few books on it, and then actually going through the list and working out, you actually invest into a fund that you want to be invested into. That's low fee. That's globally diversified. Then it is honestly some of the best hours you'll spend because over the long term, you'll put tens of thousands of pounds, potentially hundreds of thousands of pounds back into your pocket.
Yeah. So let's talk about the cons because I want to be balanced and just set people's expectations. Right? Yeah, right. So what's the cons though of investing in, global index funds and ETFs? I think you kind of did highlight that earlier, but I just want to kind of make it very clear for people.
So number one, it's not a get-rich-quick scheme at all. You're not going to make thousands or even hundreds of % overnight. It's very much a sort of passive buy and hold long-term strategy. Number two, you can still lose money and you will still lose money. So the stock market crashes very regularly. Just actually a couple of months ago, there's been a massive boom recently since the US election. But a couple of months ago, I actually shared a post where I had lost about £7,000 in 1 week because the S&P 500 dropped by about 5%, and that obviously negatively impacted global index funds and ETFs as well, because US stocks make up the largest percentages of global funds. But you will still, it's not going to go up in a straight line is what I'm trying to say. If there is a global recession or a global pandemic like a few years ago, of course your index funds will be negatively affected because the market would be negatively affected. The difference is by investing into a global index fund, for example, you're investing into thousands and thousands of stocks. So whilst Blockbuster might go out of business or Toys R Us or Woolworths, whoever it is, if you had invested money in there, you lose 100%. That won't happen with index funds because you're investing into thousands of companies around the world. So you can still lose money though. It's a common misconception. But yeah, it's very unlikely, almost impossible, a global index fund would ever go to zero because that would mean every single company in the whole world has failed. And that'd be like a nuclear war or like an alien invasion. And at that point, you probably don't really care how well the FTSE Global all cap. I will still be checking it to the dying moments, don't worry. But you probably don't really
your
care.
Portfolio. It's gone down to 1,000.
I do actually, sorry to keep saying it, but in the book as well, I do have a whole spread on all the pros of index funds and the cons. And there are a lot more pros, but there are definitely two of the cons that I mentioned, and they're probably the two main ones. It's all about patience, and you can still lose money in the short term. it's not all sunshines and rainbows. The market is very volatile. I was actually doing a portfolio update on my Instagram and YouTube channel recently, and if you look at my like 3-month graph, 6-month graph, it's literally like mental, like jagged lines. Then I zoom out 7 years, and it's like boom.
Yeah.
So it's really you got to sort of soak up the short-term volatility. And as we said, understand it's a longer term thing. Even 7 years isn't that long term. I would class long term as 10 years plus. So I wouldn't even say I've been like a long term investor yet, because I'm only 7 years in. But yeah, they're probably the two main cons I would say with index funds. The other one actually probably is that there are thousands to choose from, and I actually think that's the biggest barrier to entry.
Yeah, I think
and
so
they give
too.
them like pretty stupid names, like even the FTSE Global All Cap. It's a bit of a mouthful. Like the FTSE All World, VWRP, like UCI, and then accumulation. Like there's too many words, and I don't know why they do it, because of like rules and regulations and stuff. But the names are hard to decipher. Essentially, so then you type in even like when I was looking into my pension years ago, you type in global and you get like 20 different like global all cap, global ESG, and you're like, which one do I pick? And then it's almost like information, there's too much information, you get paralyzed, you don't make a decision. So if you can still sort of like, I guess, wade through the useless funds and find the one good fund you want to invest into, then as you say, the upfront investment, of time will be worth it for the long term. But that's probably another con I would say of sort of index funds and ETFs. So the cons can easily be avoided or sort of turned into pros, but it just take a bit of time to sort of understand it's long term. It's not a get rich quick scheme. Sort of wade through the hundreds of options and find the right one that once you've set on that option, you can just plow money into every single month.
Love that. I completely agree about it being too long.
The names are mad.
It's true. About it being complicated. Like a lot of it, like, and I've been investing for years, and still, even when I look at it, like some of the names, it's ridiculous. What I do to help me, I just look through the fact sheet.
I was actually going to say,
I just look through the fact sheet.
I actually made a YouTube video on this today. I done like a deep dive into the FTSE Global All Cap, but you can literally just click on, as you say, you go onto websites and platforms, and they like show you the fee and what it invests into. But you literally also can find the key investor document, or the fund fact sheet, whichever one's there. And it's like a 2-pager, and you can see the objective of the fund. Like, this fund aims to invest into companies around the world of large, medium, and small size. That's like the FTSE Global All Cap. You can see the risk rating, you can see the fees, and you can see the past performance. So to go back to your question before about what 2 things you look for, well, I'll be clicking into the fact sheet and looking at the objective, seeing what it actually invests into, and then looking at the fees and see what it actually charges. And you might have to wade through the shit a little bit to get to like the good one. But as you say, the upfront time investment is worth it for your future wealth.
Yeah, I completely agree. On that point of fear, right? In my time investing, and I'm sure in your time investing, we've seen a lot of fear in the market when things go wrong. It's funny that you mentioned this few months ago, because I wrote it down as one of my questions, right? Of, this fear of the stock market crashing. And I think this happens to a lot of people. A lot of people don't invest because they're scared that if they invest, they're going to lose money, right? That's their fear, right? Oh, the market's going to crash. I'm going to lose money. So therefore, I'm not going to start. Or if I do start and it crashes, I sell and then lose out. And then, okay, it's a scam and whatever, right? So the stock market can crash for several reasons, economy declining, wars, and other negative, sentiments, right? And I remember between July 31st, and anybody can go and check this, right? Between July 31st and the Monday and then 5th of August, I think the FTSE, the one that you're invested in, I think is, All World actually. I think there's a global ETF, which is similar to the index fund that you have. That declined by 5.28%, right? Which is
that's what I was just saying
huge.
A minute ago. When I lost £7,000 in 1 week, it was during that week.
That was huge. And I can't remember what happened, but there was just some mad fear that was happening around. Like,
I can't remember.
I don't know if it's because inflation had gone up temporarily or whatnot. Something happened. Let's just say we've even forgotten. That's how not big of a deal it was.
There was some like swap trade. There was some technical thing that happened where I think, there was some weird technical thing that happened, and it meant that I think loads of like short positions ended up getting sold.
Okay.
It was something technical. I think it was something like the Japanese market. Something weird happened and had some mad negative impact. So yeah, I think the US markets fell by even more than that. And that's when I was saying I lost like $7,000 in a week on paper. Yeah.
And look at that, we've forgotten about it.
And now that's what I'm saying. Once again, I think I know what your question is. Like, it's just a blip on the market.
Yeah.
Even that the COVID in March 2020, there was a 30% COVID crash where the S&P crashed by more than 30%. And I want to look at my own investment like chart. It's like you can't even see it. And that was like a few years ago. If you look back to like 08.com crash, they're massive at the time. And of course, they can be heartbreaking if you're not financially prepared. But if you've got an emergency fund and you can ride through the crash, then it's going to be a blip in a few years' time.
Yeah.
But what can people do? It's really just, I say, coming back to like understanding what the stock market is. And it's going to regularly boom and bust based on good news and bad news.
Yeah.
And it's sort of having a bit of financial education and by reading some books to like actually understand that's just what happens.
Yeah.
I've actually got a good quote in the book, and it's from another book I read called, I can't remember what it's called now, but it's actually an Australian author, and he goes through from the 1800s to today, on average, I think it's the New York Times has mentioned the word fear or uncertain on average like once a day. It's like, so it's not like a new thing, like fear, uncertainty, like war, famine, poverty, like none of this is new. It's just more like, I guess, available now because everyone's on social media and everything's so instant. But there's always been fear mongering, and yet the markets go up. As you say, since I've been investing, there's been record high modern interest rates, record high modern inflation, multiple wars, nearly World War III, a global pandemic, and yet I've made tens of thousands of pounds of gains, all on paper, of course, not sold anything, just by investing and holding.
Yeah.
I mean, people overthink it a bit, like try and buy it here, sell here. It's impossible to time the market. So that's why I just pick a fund that you want and just long-term invest into every single month, invest into it and hold for the long term.
Yeah.
But I think actually not selling when the market crashes does just come back to a bit of not getting sucked into the whole like media. You gotta understand the media is just looking for clicks and they fearmonger. It's either like absolute euphoria or like awful, and they're trying to like fearmonger you into stuff and get your click. So I mean, you can click it if you want, but don't get sucked into it and let it make you sell your investments, because you'll definitely regret it.
Yeah. How have you managed to stay patient, and not chase the quick gains? Because I feel like, in the era that we're in with the Bitcoins, the Nvidias, the Teslas, these are like the new shining. Oh, this is going like, I don't know what Nvidia has gone up, but it's definitely gone up more than 100% this year. It's gone up crazy, right? Bitcoin is back on the rise again. Everybody's talking about, Bitcoin is coming back. Look, I don't know if people know this, but I've been in Bitcoin. I'm not a Bitcoin millionaire. Yeah. I could have been if I was more...
had more balls back in the day.
Yeah, exactly. But I've been in Bitcoin since 2017. So I've seen the ups and downs of people into it, talking about it, and out, in and out, in and out. So I've seen that, So, how have you managed to stay patient, not chase these like quick gains?
I think... it's sort of just like, I think once again, it comes back to a bit of understanding. Like, there's a really good book again called The Little Book of Common Sense Investing, which is written by Jack Bogle, the founder of Vanguard. And I think I read that early on, and that really set me up on just index funds, because it's impossible to predict which is going to be the next booming industry. But what a good example. Look at NFTs. All the rage for a couple of years, and now 99% of them are worth $0. All this, half this AI stuff going on now, most will be worthless in a few years. All those like cloud computing, or like all that they've, like, some companies do succeed, don't get me wrong, but most things are like a fad and end up going away. So I think that, I don't know how I've managed to avoid it. I guess I just sort of like, in my own head, I've got set, don't get me wrong, if I see like Tesla's gone up 100%, I'm like, of course, if I'd sold everything and put it in there, I'd be happy. But I think it's just impossible to predict which company is going to perform the best, which is why I'm sort of quite content that by using the global index fund, I'm slowly going to build wealth over time. I'm not going to, and the thing as well, actually, is worth saying that you only ever hear the success stories. Like, think about your mate, right, who bets. When he wins 300 quid on a horse, he'll send you a WhatsApp little screenshot, or like he'll tell you, but you don't hear about all the losses he's been making. you only hear about the wins. But like social media, you only ever hear, and that's why on social media, when I do lose money, I do share it because it's just the realities of investing. It's not going to go up in a straight line. But I think you only ever hear the good side of stuff.
Yeah.
So like, Tesla's gone up 100%, but like most people wouldn't have made it 100% because they probably bought it high and then sold it low, contrary to what they should actually do.
Yeah.
So yeah, I don't sort of, I think I'm just probably set on my own investment approach, and I know I don't know, I can just sort of admit I don't know which country or which company or which crypto is going to perform the best.
Yeah.
So I just have like a global index fund, and then with crypto, Bitcoin and Ethereum. But global index fund, just use that essentially.
Yeah. Okay. I love that. Something I loved in your book that you talked about, right, is the investing paradox, right? You know, where I don't want to talk too much about it because I want you to elaborate on it. But it's like, and I get this comment a lot as well, and I know you mentioned it in the book, right? People, I don't want to get rich when I'm old. Everybody's telling me they want to get rich when they're quick.
Invest
I get
more.
these comments all the time. Exactly. People always like, oh, comment, I don't want to be old I don't want to be rich when I'm 50. I don't even classify 50 years old, by the way. But, you know, for any of the 50-year-olds listening to this podcast or watching it, I don't classify that as old. But people say, oh, I don't want to be, you know, I don't want to be rich when I'm 60, etc. and stuff like that, right? So you mentioned investing paradox. What is that? Can you kind of elaborate for us?
Yes, I think it's one of the most common comments I see when I make a video about long-term investing. Everyone's like, yeah, I don't want to be, you know, rich when I'm 65. It's like, okay, you don't want to be rich when you're 65. You want to be rich now. That's fine. But if you want to get rich, you know how to get rich, right? To get rich, you want to invest, because essentially it's very hard to save your way to wealth. You need to invest into whether it's like property, we're talking about the stock market, crypto, your own business, whatever it is. You need to invest to build your wealth. If you don't want to be rich when you're 60, then you need to just invest more per month to essentially get to that point earlier. And that is sort of what we were saying about earlier on with my own investing portfolio, about how I've managed to build it a lot quicker the last few years, mainly because I've been investing much more per month than in the first 3 or 4 years. So the whole paradox is, we know that we can get rich through investing, but then most people don't want to wait and like put in the reps every single month by investing, and they just want the wealth today. But unfortunately, unless you are lucky and inherit a load of money, then that's not going to happen.
Yeah.
So it is tough because, obviously, don't get me wrong, I would love to be a millionaire today. Quit my job, go traveling, do what I want, but I know it's not going to happen. So instead, I invest every single month, and then know that by doing that, one day I'll be retiring early. And if I can invest more and more per month going forward the next few years, I can then get there even earlier.
And you probably cherish it more as well, right?
I think, because
I feel like you cherish it. You worked hard for that money.
Yeah.
I worked hard for it, so I'm not going to just spend $1 million on a plane today. Oh my God, I've invested for 20 years and I'll just spend $1 million on a plane. Oh my God, if somebody posts a news article on me that somebody's done that, you know, I definitely could shut my mouth on that. But I doubt that people are doing that. I'm sure that people value it more.
It's all about the journey, isn't it?
Yeah.
People don't see the destination.
Yeah.
But like, you've seen the journey.
Yeah.
Even like you build up each month, and then it's more rewarding that way as well, I guess.
I think when you work hard for something, I think you definitely value it more because you understand, okay, if I touch this, if I use this, I know how hard it is. I'm going to have to work hard to, you know, get this again. So I think people do value it. If it's too easy, it's throwaway. It's basically of no value. So you're just like, you treat it of no value. And I think that's how you have to kind of see it. The people that say, I want to be a millionaire today, right? Let's say even, I don't know, 2 years, right? Let's say you want to get to $1 million in 2 years. You probably would have had to work crazy hard.
Like the only way really is to like make a business and sell it.
And work crazy hard. So regardless of what it is, you're working hard. That's the point, right? I think
if you do that 2 years, you inherit it or you make a business and sell it.
Exactly.
Which is that's like a very risky thing to do. Start your own business, go all in, might not work.
So either way, you're working hard for it. This is the thing. I think people have got to understand that whatever option you want, even if you want to become a millionaire, 5 years, 10 years, 20, there's an element of hard work. When I say hard work, I mean, okay, let's say you wanted to invest for 30 years to become a millionaire. I mean hard in terms of patience.
That's
being patient is hard.
Being consistent and patient.
That would be hard to do that. if you want to do it in 5 years, it'll be hard to, in terms of like running your business, and you're probably working crazy hours, right? So whatever it is, there's some element of work rate that is required to, you know, kind of do it. So I wanted to know from you, like,
And the problem though, if you don't start your own business investing, then your life is always going to be hard because you're always going to be working and living paycheck to paycheck.
Yeah.
So the alternative of really not investing like we're talking about is you're just going to be constantly relying on that one paycheck or two paychecks every single month. And then you get to like 65 and I've got the state pension, which is like 4 shillings a week to live off of, or it's probably not going to be around by the time we get there. So you have to invest. There's like literally no other option. Or you're going to be relying on the government, who I'd take the way they like do less and less for people every single year, and the pension will probably be gone when we get there. Your employer, once again, employer pension schemes are so less lucrative nowadays. Or your family, and your family shouldn't look after, like they probably will, but they shouldn't have to look after you. You should be able to look after yourself, take ownership. Whether you're 21 or 51, start investing, build up your pot. And yeah, just got to stop waiting and start investing.
Yeah, I love that. So, you know, obviously I want to talk about this, right? In your number of years investing, what's the biggest lesson and insights that you've picked up on?
So one is you cannot time the market. So it's just impossible to know what is going to happen. When you look back at a chart in hindsight, it's like, oh, I'll just like buy there, and then, oh, it's gone up massively. Like, when look forward looking, like, what is the market going to do tomorrow? It's literally a coin toss. I have no idea. Trump could come out and say something mad, and the market crashes. Russia could do something mad, and the market goes crazy high. Like, no one knows what's going to happen. So it's impossible to time the market, number one. I'd say number two, like, honestly, simplicity for me, I just value that so much. When I first started investing, I had different funds, I had different stocks. It was just a bit of a mess. Now I just use one global fund in each investing account I have, like I shared right at the start of the podcast, and it makes my approach just so simple. Another one, automation. All of my investments are automated. So it comes out of my investing account when I get paid, and I'm sort of taxing myself first, paying myself first. I don't even see the money. It goes into my investing account, and I'm doing that every single month. And that sort of automation means I can sort of not have to manually do stuff and like live life sort of outside the spreadsheet. I'm not constantly tweaking stuff and checking stuff. I know my investments are happening automatically every single month, and I can then like go about, do my 9-to-5 job, book a holiday, play football, go for a few pints, whatever it is. So yeah, that's probably like 3 or 4 of the key, I'd say, lessons that have come to mind. And a lot of ones I try to like share and get across through like podcasts and my own sort of like social media. It's just because I like, important just like sort of concepts you need to know, I guess, when it comes to investing.
Yeah. Okay, so I want to kind of end this segment on the podcast with this, right? I always get the question, I even got it the other day, how do I start investing? How do I start? Where do I start? Right? So I want to talk about practical steps, right, for people, especially beginners, right, on how they can, you know, stop waiting and start investing. Right? Yeah, see, I used it.
Within an hour.
And, you know, I really want to get people to think about how they don't have to make their first investment today, but prep themselves to make that leap and, you know, make that first investment. So there's the steps.
So the 3-step blueprint to start investing is you pick an investing platform, sometimes called a broker. Step 2, you pick an investing account. The best probably options in the UK are either a stocks and shares ISA or a pension, whether that's a workplace pension or a private pension, sometimes called a SIP. And then step 3, you choose an actual investment. Index funds, ETFs, individual stocks. It's ultimately your money, so you can invest into whatever you want to. I personally, just as we mentioned, stick to global index funds. It's the only fund I need, the FTSE Global All Cap specifically. That's what I personally do. So that's all the actual 3 steps to start investing. So the main way that I follow that, I have a Vanguard account, as my platform. I then have a stocks and shares ISA account and a SIP account with Vanguard. And I then have the FTSE Global All Cap be my main investment in both of those 2 accounts on Vanguard. Okay. And that really is a massive bulk of my portfolio. The actual practical steps though, like that's sort of more theoretical. It really is as simple as just like joining a social media. You will go onto the App Store or onto the web, onto Google, type in Vanguard, Trading 212, Hargreaves Lansdown, whatever platform you want to use. And then it really is simple as just you sign up, you put in a few details as if you're signing up to Facebook or whatever it is. And then normally as part of the sign up process, you can then choose to open an account. So a stocks and shares ISA, for example, and it sort of then just guides you through the process of what to do. You normally like pick the specific fund you want to invest into, how much you want to put into it, what day the money is going to come out if you want to have an automatic investment. But it really is just as simple as just whatever platform you want to use. I'm obviously a big fan of Vanguard. Unfortunately as well, I get this a lot, I'm not sponsored by them or affiliated with them. I wish I was. I talk about them a lot.
Yeah, we need to get that. We need to get that happening. Yeah, we need to get that happening.
Go onto like a platform or an app and just essentially log in, sign up. As part of that, you'll probably create an account, usually a stocks and shares ISA, and then boom, you pick something to invest into. Click, and it also, the actual process of investing as well is generally very easy. Normally, if it's on Vanguard, for example, you can actually set up an automatic monthly investment. So I started with £100, or you can make a one-off lump sum investment and you put in your bank details, and then the money usually comes out within a day or two. With like Trading 212 or some of these apps, you can often deposit money instantly from a bank transfer, and then the cash is then in your account on the app, and then you just invest it into whatever you want. So the actual process, really is, it's actually quite funny because it's almost like with Vanguard anyway, you can actually also like add funds to your basket. It's a bit like being on Amazon. You like find the fund, add it to your basket, then you like put in your credit card detail, or sorry, not credit card, debit card details, bank details, and then boom, that's the sort of practical process to actually start. And there is actually a couple of bonuses that comes with this book, but there's a QR code in there as well. And then it takes you to a sort of website, and you can see how I even got my mum started investing a couple of years ago. And it took a few minutes. And it shows all the exact steps on what you click and how you go through it all to actually start investing. I think it's one of those things where like people think it's really daunting. I completely understand that. Because like, there's so many platforms, like what do I do? But then just literally go onto the platform. And the thing is, you can have like multiple platforms.
Yeah, now you can. Before you couldn't.
It's not like a mortgage where like you're locked in. Now you can have multiple platforms, multiple stock shares ISAs. So if you want, try out a load of them.
You can try them all, put pound in all of them and just like that,
most. So
before they used to make you only have one stocks and shares ISA every tax year. But I'm very happy that they opened it up so that if you want, like you say, you can, it's almost like spreading your risk, right? Okay, I can have one account one here, account two here, account three here, and have different investments across them. It's up to you, right?
It's up to you.
It's like bank accounts. I know a few people have multiple bank accounts as well,
better interest rates, fixed account, regular saver, easy access account.
Exactly.
But the actual practical steps, it will probably surprise you how easy it is once you actually go onto the website or app, and you just follow the site, the sort of create an account process, and then that's you set up, and then to actually make an investment, it's usually either a case of adding cash and investing it, or adding the investment to your basket and then checking out and putting in your bank details, and then boom, you're officially an investor. Yeah,
exactly. You're absolutely right in terms of the steps and actually the process of doing it. All these applications are so much easier. Like they're very straightforward.
It's easy to do.
The time is spent on deciding what you want to invest on. That's where we said up front.
The hardest one is like your platform account, and then the actual investment step 3. It's definitely the hardest option because there's thousands of stocks, index funds, ETFs. And the reason, that's honestly why I value the simplicity of global index funds so much, because I just use one global fund in each account. I could have a load of stocks, a load of funds, and it's fine if you want to do that. As we said, it's your money, you can do whatever you want. But that simplicity, I really value. And it means I've not got like all these different funds to look at and manage and understand. I just have it all in one global fund. And as the global economy continues to grow and innovate, then my wealth will grow slowly with that.
Yeah, amazing. Absolutely amazing. I just want to touch on 2 parts of this, right? I think is that you mentioned that important. Automation. You mentioned automation. Pretty much all these platforms you can do automation.
Pretty much every platform nowadays
lets you automate your, can you talk about the importance of that automation and why that's been important for you as an investor?
It's a good sort of analogy is if there's cake on the table, you're probably going to eat it at some point. If there's money in your bank account, you're probably going to spend it, and it's going to be gone before the next payday. So if you can automate it, preferably close to getting paid, then the money's gone and it's invested. And then you then live off of whatever's left in your bank account for that month, your other disposable income. But by setting up that automatic investment, not only is it just easy because it's hands off, you're not got to like go into your banking app and transfer money to your Trading 212 app and then find a fund and The risk I think of automation is as well, with manually investing, is you might look at the fund that day and be like, oh wait, it's high, it's gone up by 5% the last week. I'm not going to invest. I'm going to wait.
I had that.
I'm going to wait till it goes low.
Yeah.
All these like high, low. What
to
does that
me,
even
yeah.
mean? Like, it doesn't mean anything. High, low. So by automating it, it's just going to happen every single month. It doesn't matter what the price is. You're going to cost average every single month. And the most important thing is you're investing. And you're not going to like second guess yourself like, oh, it's a bit high, let me wait till next week, it'll come down. Then it's even higher, then it's like, oh, let me do it now. But then you missed out on some gains, and just automate it one day, specific day every single month. And yeah, just massive benefits. And it makes it so much less manual and you messing around with different apps and transferring money and stuff.
Yeah. And then the second part that I want to talk about is fees, right? How do you minimize fees for like investing? Because that eats up your
it's
money,
massive.
right?
I think people don't underestimate the impact of fees. Even if you pay a fee that's 0.5% too high per year, over the long term, 20, 30, 40 years, that'll cost you 5 figures easily. Just because that essentially is coming out of your pocket every single month and go into the investment provider or the fund provider. But the main 2 fees we will pay will be the platform fee and the fund fee. So the lower you can get those 2 fees, the better. It's also worth saying, if you are day trading and buying and selling a lot, that is also going to incur fees. UK stocks incur stamp duty, overseas stocks and funds incur FX fees. There's then bid-ask spreads. There's other like trading fees, commission fees, dealing fees, hidden fees. It's a minefield. If you are, though, just hopefully investing automatically into low-cost index funds and ETFs every single month, the main 2 fees will be a platform fee and a fund fee. And yeah, realistically, the lower you can make them, the better. Because then you've got more money compounding in your pocket over the long term. The key thing I'd say here is, if you're not sure on the fees, contact the provider. I've done this with every workplace pension I've ever had. I've always struggled to find the fees. So I literally either like message them on the chat or just call them and be like, I'm using this. This is my employer. I'm in this fund. What is my fee? Find out that way. And the second thing is, if the fees are difficult to find out, that's a massive red flag. I know some platforms make it confusing and it's just a red flag. And that's why another reason why I really like Vanguard. If you just Google Vanguard full costs and charges, there's a PDF that comes up, the first hit, and it's literally a PDF of every single fund and every single fee you'll pay per year. So you know exactly what you're paying. It's completely transparent. Not all investing platforms are like that. Some of them like to cover it up because then they're essentially making more money from you without even realizing. But yeah, that's
So
what I'd probably
cheeky,
say on
isn't it?
fees.
Yeah, okay, cool. I'm going to end the podcast on these 2 things, right? So crypto, I have to ask you about crypto because I know I get somebody in the comments, you've had this whole podcast talk about investing, but you don't mention crypto. What's going on with crypto? I'm going to see if I can talk a bit more about crypto.
Yeah.
Is that, I don't mind crypto because I'm invested myself. I'm just very aware and conscious that I don't want to sell a dream to people with crypto. Crypto, yes, there are huge gains, but I also want people to understand that you can lose money in crypto. Like,
How many Lamborghinis you got now?
I got 10 Lamborghinis. Zero. I got 0 Lamborghinis. I got no Lamborghinis. So, people are very interested in crypto again, right? Bitcoin is, up, and people are thinking it's going to go up to $100,000, pounds, etc. Right? I guess, what's your thoughts on that, and what do you think the future of crypto is?
Yeah, so I'm personally a fan of crypto, and I think it's certainly high risk, high reward. It's very volatile. I think on average, Bitcoin has lost 90% of its value every 2 years since it existed in 2008. So you've got to sort of understand it's a very new asset class. It's only been around for 16 years. And even the biggest and best crypto, which makes up like over 50% of the crypto entire market capitalization, still loses 90% of its value every 2 to 3 years. So it's very volatile. It's very high risk, very high reward. But I think as sort of a young person, whilst the bulk of my money is still in global index funds, about 80 to 85% of the money that I've got invested, I think 10 to 15% for me is what works. Because if it goes mad and makes me a load of money, great. But then if it goes to 0, which is still just as likely, the fact Bitcoin going to 100,000 and 1 million, no one knows. If it starts getting shut down by governments, people start banning it, something happens, like no one knows, right? If something happens, it could equally go to zero. It's an equal chance. And for me anyway, if I lost 10 to 15% of my portfolio, that'd be, 5 figures and it'd be awful, but it's sort of something I could recover from. I think the problem is with crypto, people like go all in and it's like life savings on this random coin that someone said on Reddit, and then you lose all your money. Like, why do you think that happened? Because you like just, or a guy down the pub says this coin, you put a few grand in it that you've got saved, and now all of a sudden it's gone because it's like gone to zero. I think it is still a bit of a wild west. I think it's not like obviously the stock market's been around for hundreds of years. It's very regulated, very structured. Companies produce financial statements. You sort of know what's going on. But then I think because of that, even though I'm saying it's a con, there's also an opportunity, of course, to make a lot of gains, and some of the gains have been mad, especially recently. I'd probably say that for me anyway, I personally invest into Bitcoin and Ethereum every single month, and I've done that for about 5 years now. And why I did that initially was because I actually read some books and educated myself about crypto. I did extensive reading, and I sort of believed in it as an asset class, and I thought it was worth putting about 10 to 15% of my portfolio in. But because there's not like an index fund, unfortunately, for crypto, or there actually is Bitcoin and Ethereum ETFs now in like the US, but not in the UK. I just stick to the big two, which is Bitcoin and Ethereum. But those specific books, I read them years ago. There's one called Crypto Assets, which is very good. There's one called crypto. Actually, let me go. So there's one called Digital Gold, which essentially is the story of Bitcoin and how it came about. That's a good read. There's one coin called the Bitcoin Standard, which is a history of money, and then it makes the case of like Bitcoin being the new monetary standard. Then Crypto Assets, which is actually more looking at specific cryptocurrencies and their use cases, how to actually hold and store crypto. I'd probably say those 3 books are where to start. I've also read some mad books, like I think there's one called like Mastering Ethereum and Mastering Bitcoin. It goes into the actual like how the blocks work, how the code, it gets like very complicated, and it's even above my head. I don't understand it, but I just think, for me, a bit of my money I put into crypto every month, it's not, most of my money still goes into index funds, but I sort of make that risk reward bet where if it makes money, then fine. If it doesn't, then it goes to zero. I'll still survive and go back to the index funds.
So you're not cashing in all your chips into crypto, and you're taking a very calculated risk.
I think that's the mistake people make, where they put everything in it, and then when it inevitably crashes 90%, or the random coin they invested into goes to zero, they then like act hard done by, and it is obviously unfortunate and sad, but it's like you put all your money into a random like unproven asset. So I think just taking like a calculated risk, as you say, in my opinion, is the best way to go about it. There are some, like they call them Bitcoin maximalists, where all of their money, all of their wealth, everything is in Bitcoin. Bitcoin is going to be the greatest thing in the world. It's going to save all these world problems, and it might do. And that's what I don't know. So that's why I just put 10 to 15% of my money personally into it. And it's sort of like a calculated risk. That's a good way to explain it, to be fair. But where's it going to go? I mean, the thing is, I think one of the things that got like Trump elected was because apparently he's going to be like the Bitcoin president.
Okay. Wow.
Or the crypto president. They're going to like start actually trying to like encourage mining in the US, make the US some sort of like crypto hub where it's encouraged. And apparently they're going to start buying Bitcoin as well, like the actual treasury in the US. These are all things that are speculated. So, and that's why Bitcoin has been pumping recently in like since the US election, is because everyone thinks like the new government, Trump, they're going to do like mad things to support crypto, essentially.
Okay.
Once again, who knows? Politicians say stuff and then don't do it or lie about it. Happens in this country like every week. So it might all be a lie. I don't know. But I think it probably is looking positive now, because if they do support it, if the US, the biggest global superpower, is supporting it and encouraging it, you would think that other countries would then follow suit, because no one wants to sort of fall behind. A bit like sort of like space race between like US and Russia. Now it's like, crypto race. So that's what I'd probably say on that.
Okay.
Obviously you can talk about crypto for hours and it gets a bit more complicated. But hopefully that's like a quick 5-minute overview that's helpful for people anyway.
Okay, cool. I mean, people, let me know in the comments if you want me to talk more about crypto. I'm very hesitant because obviously
It's got a bad rep, to be fair.
I care about my audience. That's the truth, right? I care about, the community, people that watch and listen to the podcast, and I'm very conscious of that. That I do get comments from people, oh, you don't, on this, you talk about investment, you don't talk about crypto. That's a conscious decision because I understand how volatile it is. I've been in it since 2017, and for me, it's just like, okay, I don't talk about it because I don't want you coming back to me and be, Atto, you talked about it in the podcast, I put everything in it and I lost it all.
Yeah.
That's why, it's got to be that, right? Like sometimes, but if people are like, Atto, cool, let's talk more about it, then I'm all for it. But just also know that the risk is all yours. It ain't on me, right?
I'll honestly just say those 3 books I mentioned, just read those books.
Yeah.
And if it makes you like crypto, start investing a small amount per month. The platform I personally use is one called crypto.com. And if you don't like crypto after reading those books, just focus on the stock market because that's still going to build your wealth anyway.
Yeah, exactly. There's so many ways, man. Property, stocks, crypto, you got options.
And you can diversify between them. And if you can do that, I've not got any property myself. I hope one day I'll have my own home, maybe an investment property, then got some crypto, then got the index funds. And I think that's sort of like, when you talk about the end goal actually, earlier on in the podcast, that's probably one of the end goals was like these different asset classes, diversifying different income streams, to then sort of contribute to like living life on my own terms.
Yeah, love that. So the book, your book, author, Stop Waiting, Start Investing, right? What can people expect from the book?
So the book is mainly aimed at sort of beginner investors or people who have just recently started, and probably people who are a bit younger. So probably anywhere from like teenager up to, I'd say, sort of like 35 maybe. But I would actually say anyone can read the book. Even if you've been investing for years or if you're a bit older, everything in the book still applies. The first section, this book's split into 3 parts, and I've drawn a lot of like my own mistakes, my own experiences, my own stories, people I've spoke to over the years about investing in the stock market and what's actually happened. There's a lot of like data, charts, compound interest calculations. But the first part is like the foundation. So laying the foundations, what is investing, how do we make money, what to do before investing, what to think about before investing. Part 2 then goes into the actual investing world. So like the stock market, what is it? How does it work? What are index funds? What are the pros and cons of index funds? You've got passive investing, active investing. And in part 3, then probably the most useful part, but I'd suggest people don't skip to that because you got to sort of build the other foundations first. But part 3 is then the 3-step blueprint, and obviously shared it earlier on in the podcast, but we go through choosing the platform, choosing an account, choosing an actual investment in a lot of detail, and particularly of choosing an investment, I obviously share my approach of global funds. We take a deep dive into the FTSE Global All Cap, but I also sort of share why I don't use US funds, and there's a lot of like data and graphs that sort of shows how the global economy ebbs and flows over time, and why I ultimately use global funds. And it sort of then concludes with, ultimately practically starting to invest using that 3-step blueprint, and then you can build your wealth slowly over time. I think even if you are already investing or a bit older, give it to a kid, grandkid, niece, nephew, get them to stop waiting, start investing. But it's obviously buzzing. I'm buzzing to have a book, bit nerve-wracking, bit excited. I'll be glad when it is out there. It's been a sort of 18-month process of the publisher. Like, you got the cover, then you got the blurb, then you obviously I've got the book, then you edit it, like add sections, delete sections, then they're like marketing it, and I'm doing marketing stuff. So it's been like a good experience, and it's pretty mental. And I can't believe there's like physical copies of it. It's mad. I genuinely, it's sort of, I've actually shared a lot of like stuff from it in this podcast, and it's sort of just like a condensed, structured way to sort of go from knowing nothing to actually starting investing is probably the best way to put it. And probably I guess the best thing is that everything in there is stuff that I've literally personally done over the last 7 years to go from 0 to 100,000 plus. And it's not some like bullshit like fake guru made millions overnight. It's like consistently investing every single month, and then sort of hopefully shows like a realistic path to actually slowly building your wealth.
And that's what I'm glad that you got this book deal and you were able to write this, because like I said, the receipts are on Instagram from your 6 years of doing this, and you're able to translate it into a book to help people. For me to understand investment, books is what I had to read, and I'm still even reading more books, and reading your book is great. It's fantastic. It's got so much information. And I think that's what you need a combination of stuff. It's not one or everything. You need a lot. You need different sources, and I think it's okay to I think as an investor as well, it's important to continuously, you know,
Yeah.
educate
reading
yourself.
books now.
I'm still reading books.
Yeah.
Do you get what I'm saying? Even like the Bitcoin study, I've got that book,
Yeah.
right? And that's something that's on my list to go and read. I'm still reading, and I'm still gonna forever read. That's just me, right? So
no, that's a good point. No, it probably actually is. Another way to put it, it's probably like the book that I wish I'd read before I started investing.
Yeah.
It would have avoided a lot of the mistakes. But also, and this is actually the reason why I started Making Money Simple, everything was just based from US people. And even most of the books that I've read that I really like, Simple Path to Wealth, Psychology of Money, I Will Teach You to Be Rich, The Little Book of Common Sense Investing, they're all written by US authors, and they're all written from a US perspective.
Yeah.
This is actually, don't get me wrong, a lot of the principles do apply globally, but it's more of like a UK specific writer and like approach to it. So hopefully it actually helps people out, back home here in the UK.
Amazing. Thank you so much, Ryan, man. It's been great catching up with you, man.
Good,
and thank you so much for your time and just sharing all your insights and wisdoms. I hope that, you know, the people, I'm not even hoping, I know that the people, you know, watching, listening have probably, you know, taken a lot from it. Where can people find you if they want to connect with you?
Yeah, I was going to say, Making Money Simple on essentially every social media. I generally try and post as much content as I can, whether it's like my own podcast, YouTube channel, TikTok, Instagram, you name it. If you've got any questions about anything we've gone through today, feel free to DM me at any point, and I can either try and help you out or point you in the right direction. And Making Money Simple. And of course, Stop Waiting, Start Investing, 26th of November, 2024. Get a copy, read it, give it away, whatever you want to do with it. Would really appreciate it.
Yeah, amazing. Thank you so much, Ryan. Like I said, like really good to catch up with you. Well done. No, well done on all the achievements, man. Like well done on, you know, for me, you're a legend in the game.
No,
man.
thank you, mate.
And you supported, you know, people. Look, this guy supported me when my page was small. Right, so this,
you're one of the OGs. We were doing it
well,
together.
yeah, but I mean, you had started, I think, a year before me, and my page wasn't that big. I think I was like under 1,000, but you were sharing my stuff, so I do really appreciate that, and I want to, I wanted to say that to you as well, and keep doing what you're doing, you know, sharing the wisdom and helping people to invest. Like I said, I really appreciate the fact that you're transparent. You are definitely one of the only people really that I know out there that is really transparent in this process. And I think it's important for people to understand how to get there in a realistic way, right? Like I think showing those steps is important. Do you have any final words for watchers and listeners?
Stop waiting, start investing.
I love that. Thank you so much.
Thanks for having me on. It's been great. Whoever's listened, hope you've found it useful. And obviously, do actually start investing though, because for all the reasons we've talked about in this podcast.
Yeah. Amazing. Thanks so much for tuning into this episode of the podcast, and we will see you next week's episode.